got a question from Jason, which was, can you give me more information about how my funds are spread out or invested?
Yep. So I'll maybe use our balanced fund as an example to really give an idea and bring to life how diversification works from that perspective. So if we take it right at the very start, we have diversification by manager, i.e. the person that's looking after the client's money. So we use 9 managers within the balanced strategy. Each of those managers offers us a different style in terms of the approach they take, from pure stock picking approaches to a very diversified using alternative based strategies to build the solutions. And then if we dig further into that, so 9 managers digging further down into that, we then have to think about the underlying asset classes that we would have exposure to within that strategy. And what do I mean by that? If we think about the equity market, we've got about 55% exposure to the equity market in the balanced strategy. And that then is further diversified across the globe. So we've exposure to US, we've exposure to the UK, Europe, Japan, Asia, and China. So significant diversification there within the equity sleeve. And then if we move across to bonds, we've effectively got about 30% of the balanced strategy in bonds. Bonds seen as a diversifier relative to equity risk. And within that, then bonds can be further subdivided into exposure to sovereign bonds, those that are issued by the likes of the UK government, the US Treasury, and other global or other countries, I should say. And then that further breaks down into corporate bonds, which we can further subdivide if we want, thinking about investment grade and high yield. So further diversification within the underlying asset sleeves. And then the remaining part of the portfolio, there'll be a proportion of that sits in cash, and then there will be alternative assets. And those alternative assets offer, in the main, uncorrelated returns to the equity market. So if the equity market's weak, those alternatives generally are providing a bias or a ballast in the portfolio against that. So diversification by manager and diversification in each of the underlying asset classes that we have exposure to in the balanced strategy.
And that's not really important, I think, Jeff, what you're saying, particularly towards the end as well, which is sometimes I think people see markets go up or markets go down, markets being the FTSE, for instance, and then they automatically think, oh, well, that's, that means my funds are up or down as well. But that diversification of asset class doesn't necessarily mean that, does it?
No, it doesn't. And I think this is a really important point, and something that kind of really frustrates me about the way the media report on financial markets in particular. And, you see the headline, market down X, pensions are all down by the same amount. That's not the case.
Yeah,
I don't know anybody, to maybe David's point, unless they've got a sort of a very aggressive and betting scenario, that they've got their pension fund allocated to one particular asset. That's just not the way most people would think about structuring a longer term savings product. So by virtue of suggesting that in the market, it's not what you want. So what does that mean for a balanced strategy? Well, we've got a beta of about 0.39 relative to the equity market. So for a 1% move, our portfolio will move 0.3%.